Okay, so this next video lecture is the continuation of our modules 3 entitled um, Cost Accounting Cycle. So here we will discuss or continue to discuss about the accounting methods and our cost of goods sold. Okay, so as we have mentioned in the previous video lecture, so basically your cost of goods sold will be affected by the inventory costing method that an entity is using. Okay, so here there are three methods, okay, aside from what we presented in the previous video lecture. So aside from FIFO and LIFO, we also have the average cost method. So again, in practice, basically what is actually used or followed is either FIFO or average cost method. LIFO method is now excluded. Okay, so LIFO method is just presented for illustration purposes. Okay, so FIFO, so the same as what we have discussed before. Okay, so meaning here the earliest goods that were purchased or produced, this should be sold first. So since prices, for example, tend to increase over time because of inflation, so the company that uses this method will sell its least expensive products because since the trend is increasing, so meaning those items which were produced or purchased first has lower cost, okay, compared to the new ones. Okay, so that's the reason why. So again, the effect of this is we will have a lower cost of goods sold because the cost of these items are also lower. Okay, so hence the net income, okay, using the FIFO method will tend to also increase over time because since the inventory sold has lower cost, so in effect your cost of goods sold will be lower also, so this will be deducted from your revenues, and as the time passes by using still the FIFO method, your income will tend to increase over time because again our cost of goods sold is lower. What about for LIFO method? So again, this is just the opposite of FIFO method. So under the last in first out, the latest or the new goods added to the inventory should be sold first. So during the period of inflation or rising of the prices of goods, so here the entity will sell those inventory which has higher cost. Okay, so it will lead to a higher cost of goods sold, and over time, in effect, the net income of an entity will tend to decrease because in this case, under the LIFO costing method, the cost of goods sold is higher, so the effect is lower income. So the trend will also be decreasing in this case for the entity. Okay, and for the average cost method, so here, what the entity will do is to compute the average price of all the goods in stock. So, for example, the first item that was in stock has lower cost, and then they will add another or new item which has higher cost. So, the entity here will add this prices and average it, okay, to get the average price of these goods. This is how it is done in the average cost method. Okay, so here, this is used to value our cost of goods sold. So taking the average product cost over time has a smoothing effect and will also prevent our cost of goods sold from being highly impacted by the changes in the costs of one or more acquisitions of the purchases, because here the entity will consider only the average cost. Okay, so it will tend to have a balanced cost of goods sold that will be reflected in our income statement. So aside from these three, the entity can also follow the specific identification method. So here we have or this method uses a specific cost, okay, for each unit if merchandise, or also called as inventory or goods, to calculate our ending inventory as well as your cost of goods sold for each period. So in this method, so the business know precisely which item was sold and the exact cost of it. So meaning they really account what is the exact or the specific cost of the item that was sold. Okay. Further, this method is also typically used in industries that sells unique items like the cars, real estate, and rare or precious jewels. Specifically, using this method, specific identification, they usually follow the perpetual inventory system. Okay, because they account um, each transactions that relates to the inventory. Okay, so those are the different accounting methods for inventory. Okay, and also that has effect on the preparation and calculation of our cost of goods sold. So what are the exclusions from cost of goods sold? So many service companies, actually, they do not have any cost of goods sold at all. What they have is cost of services. So cost of goods sold is not actually addressed in any detail, okay, in our GAAP, but cost of goods sold is defined as only the cost of inventory items sold during the period. So if we will base this definition, basically service companies are not included under this definition because they do not sell goods, they are rendering services. Okay, so not only do service companies have no goods to sell, but yearly service companies also do not have inventory. Okay, so that's why, but they have supplies. Actually, those are the items that they use in aiding them to render their service, but basically they do not have their inventory because what they have are their services. Okay, if cost of goods sold is not listed on the income statement, no deduction can be applied for those costs. That's why for the income statement of a service type of business, you cannot see an item on cost of goods sold. Okay, what they do is just they directly classify their expenses as general and administrative expense or specific expenses account, but they do not use the cost of goods sold. But actually, they can use cost of sales or cost of services, I mean, cost of their services. Okay, but because of this definition given in our standards, so basically, for a service type of business, okay, they directly classify their expenses and deduct it from their revenues. Okay, so examples of pure service companies include accounting firms, law offices, and others. So even though all of these industries have business expenses, and of course they spend money to provide their services, or they have their capital, okay, so they do not list cost of goods sold in their income statement. So again, what they can use is the cost of services. Okay. Cost of revenue versus cost of goods sold. So in this case, when we say cost of revenue, so this exists for any ongoing contract services that can include raw materials, direct labor, shipping costs, commissions, okay, and others. So these items cannot be claimed as cost of goods sold. Basically, cost of revenue, since this is for an ongoing contract, an example of this is, okay, later on we will have an example of that. Okay, but basically, this is related to an ongoing contract, meaning there is still some commitment or service maybe that an entity should perform to the customer before the product, okay, can be considered finished. Okay, so that is for cost of revenue. While cost of goods sold, this pertains to the cost of the inventory that was sold, okay, during the period. So these items cannot be claimed. Okay, your cost of revenue cannot be claimed as cost of goods sold without physically produced product to sell. However, okay, so in the US, they list some examples of personal service business that do not calculate cost of goods sold on their income statement. Okay, so we've mentioned this earlier. So many service-based companies have some products to sell. So for example, the airlines, hotels, they primarily provide services, okay, such as transport and lodging. They do not sell their inventory, okay. That's why they belong to service-based company. Yet they also sold gifts, okay, food, beverage, and other items along with it. So these items will be definitely considered to be goods, and these companies will have inventories for such goods. So because of that, both of these industries can list cost of goods sold on their income statement and claim also them for tax purposes. But again, for cost of revenue, an example of this is constructing a building, road, or bridges. Okay, a project which is still ongoing, and the contract of construction was not yet perfected because the product was not yet finished and delivered. That's why it's still under the cost of revenue. So in your advanced accounting, you will learn more about this, especially in accounting for long-term contracts, construction. Okay. What about for operating expense? Okay. Both operating expenses and cost of goods sold actually are expenses, okay, that the company incurs in running their day-to-day business. However, these expenses are segregated in our income statement. Your cost of goods sold are expenditures that are directly related to the production, while your operating expenses, they are expenditures that are not directly tied to the production of goods or rendering of the services. Basically, your operating expense includes selling, general, and administrative expenses. Okay, so these are the costs which would be included in our operating expenses, and they have their separate line item in our income statement. Okay, so basically they are expenditures that are not directly tied up again to product or to our factory overhead. So we have here an example of operating expenses. Okay, so rent, utilities, office supplies, legal costs, sales, marketing, payroll, insurance costs, okay, and others. So this is just to differentiate between an operating expense and cost of goods sold. So what are the limitations of cost of goods sold? So again, your cost of goods sold actually can be easily manipulated, okay, depending on the objectives or the interest of the management. So they can alter it by allocating inventory higher with higher manufacturing overhead cost, okay, overstating the discounts, overstating returns, okay, but all of this are related to the fraud, okay, committed in your cost of goods sold. But again, this should be avoided, okay, and the entity should follow the standard in accounting for these costs. So basically, when inventory is artificially inflated, meaning it was intentionally manipulated, so cost of goods sold will be underreported, okay, which in turn will lead to higher actual gross profit because in this case, they lowered their costs. and um, investors who will look into the company's financial statement, okay, they can spot this unscrupulous inventory accounting if they will check, okay, for inventory built up, such as inventory rising faster than revenue or total assets reported, or they can also look into the financial ratios that will support this claim of the management. Okay. So what about the components of your cost of goods sold? So basically, again, as mentioned before, this includes all your direct costs that was used during the production, okay, or the acquisition of the inventory sold by a company. So as a small business, your cost of goods sold can help you run more efficient and profitable company. So basically, the main components of the cost of goods sold are the direct expenses. Okay, so we've mentioned this before as the production cost, inventory acquisition expenses, the labor, raw materials, and indirect labor and indirect materials. But again, the indirect costs such as the marketing and distributions will not be included in your cost of goods sold because this will be part of the operating expenses. Okay, so cost of goods sold statement will compile all the cost of goods sold for an accounting period. So in greater detail, um, this will be found, okay, or this is presented in our income statement. So your cost of goods sold statement is not considered to be one of the main elements of the financial statement because this is just an element of your income statement. Okay, so if presented at all, it appears in the disclosures or notes to financial statements only. So meaning what we can present in the financial statement is already the net amount, and the computation can be presented in the notes only to financial statements because again, your cost of goods sold statement is not an important element of financial statement. So the cost of goods sold statement based on the cost of goods sold formula, that is with the use of periodic inventory system. Okay, but again, depending on the costing method, okay, that is used, or inventory costing method that is used by the entity, so again, it will have a difference. So for our periodic inventory system, as mentioned earlier, this is accounting for the ending inventory at the end of the accounting period and then using the simple formula, but this is again applicable only for merchandising type of business, whereas the perpetual inventory system is accounting for any transactions that relates to the inventory. So every time they have the transactions, they will record or account it, okay, to reflect the change in your inventory levels. So how the cost of goods sold statement is used. Okay, so here the concept of cost of goods sold statement is more useful when it is reported in a horizontal reporting. Okay, but when we say horizontal reporting, this is of course to see the trend side by side, okay, for multiple months. So when this is done, the reader can see the changes, okay, in the costs, the pattern or the trend of the cost over time. So this is useful to present information in a horizontal format, or you can also use the percentage basis, because if you can see the percentage equivalent, you can easily determine if that is increasing or decreasing. Okay, so this statement could also be used to a retailer, okay, which purchases and sells merchandise. So in this environment, certain line items would not be used, such as the direct labor and overhead, because they do not produce their own inventory. They just buy and resell it. So this is for our periodic inventory system. Okay, so we will continue with the discussion on the types of inventory used to prepare cost of goods sold in the next video lecture.